The top business stories live from the Sky News City studio. A shock fall in inflation, down to 6.7%, despite rising oil prices. The pound also falls as markets reconsider whether or not the Bank of England will raise interest rates again tomorrow. Plus, putting the brakes on net zero. We'll get reaction from the motor industry to the planned delay on ban to new petrol and diesel cars. Good morning, this is Business Live with me, Ian King. The headline rate of inflation unexpectedly fell last month due to a drop in hotel prices and airfares and due to food prices rising less rapidly than they did a year ago. On the Consumer Prices Index measure, inflation in August came in at 6.7%. That was down from 6.8% in July. The market had been expecting inflation to rise again due to higher petrol and diesel prices. The surprise figures have raised the possibility that the Bank of England may not raise interest rates tomorrow, as had been previously expected. Well, with me now is our economics editor, Ed Conway. I mean, Ed, big surprise this. A lot of it seems to be down to what the Economist call base effects in food.
Yeah, that's right. I mean, food prices kind of outweighing that. Everyone knew that, petrol prices were going to be rising, but obviously you've got other things, those base effects, you've got food prices, you've got accommodation services, other bits and pieces kind of outweighing the other side. And what's interesting, actually, is when you look, and these things do matter. I mean, people go on about, economists always get things wrong, but it does give you a kind of sense of what's expected. And obviously the Bank of England, in particular, is kind of looking out in the future. It's got its forecasts. It's trying to work out where inflation is compared with where it actually kind of comes out. So if you compare those expectations with what's eventually happened, this, by my reckoning, is the biggest downside outturn in terms of inflation that we've seen since the beginning of the cost of living crisis. There were lots of upside surprises. This is the biggest downside surprise. And, perhaps there's a sense of momentum there. Perhaps it suggests that in future there may be further downside surprises. We just don't know. But what we do know is when you look at markets right now, when you look at what they're pricing in for the Bank of England, well, before this data, they were talking about maybe an 80% chance of another hike, so up to 5.5% tomorrow. Now it's kind of evens, about 55% maybe. Probability of a hike. A lot of economists I talk to, they still think maybe the bank is going to go ahead. It's an insurance hike on interest rates, given how high they are at the moment. Maybe there's less risk of damage. But that comes back to this kind of broader point. What is bringing down inflation at the moment? Partly, it is recessionary effects. It's the fact that interest rates are higher, people don't have as much money, and as a result, they're not going out and spending as much, which is contributing to that fall in inflation. So we're seeing that on the high street. We're seeing that potentially elsewhere as well in consumption. But broad picture here, yeah, it's kind of, we've had so many bad news surprises, inflation being higher, looking like it's kind of got free, got loose. It is relieving, at least, that we have finally some numbers where inflation is coming in below expectations, and it makes tomorrow interesting. It's really quite finely balanced, and who knows, it's possible the bank pauses rather than going ahead with what a lot of people think is that final hike in interest rates.
Yeah, as you say, Ed, it really is a coin toss now whether or not the Bank of England raises again tomorrow. One thing that strikes me, though, about the bank is that services inflation, key component of the basket, appreciably below where the Bank of England was expecting. That is pretty embarrassing for the bank when its forecasting is under the microscope right now.
Yeah, because, they have this inquiry into their forecasting. Ben Bernanke, the former Fed chair, Nobel Prize winner, is coming in to try and look at what has gone wrong there. And it's happening again. I mean, admittedly, like I say, this time it's happening in the right direction because it's suggesting that inflation is more under control. But also, look at core inflation. Core inflation considerably below what they and the market were expecting as well. Services inflation, as you say, that's the stuff they're looking at, which gives them a sense, they think, of the kind of underlying rate of inflation. That's coming down as well. So it's all kind of good news story in the sense that, if you were worried about an inflationary spiral, well, maybe here's some evidence that it's not quite as spiraling away as it looked before. But then they do obviously look at other metrics as well. Inflation is the main thing they're targeting. 2% is what they want to get to. And this looks like it's kind of in line, if not better than what they were kind of forecasting. But there's also wages as well. And wage inflation is higher than expected right now. And that's something they're quite sensitive to as well. But my impression from having spoken to people in the bank is they sense, they are starting to see at the leading edge, they're starting to see I mean, recessionary is kind of a big word, but it's recessionary impacts from interest rates. You raise interest rates, it makes life more painful for people. They don't go out and spend, and that pushes down inflation. It's kind of quite simple, the mechanism here. They are starting to see that now, and the worry is that's got got recessionary impacts, but by the same token, it does bring inflation down. So as I say, the decision will be interesting tomorrow, but also let's not lose sight of the minutes. So we might get a signal from them if they do raise rates, for instance, that might be it for the time being. And, you know, after all of these increases, can't remember if it's is it 11 or 12 in a row, that now might bring to an end this kind of increase in interest rates.
OK, thanks, Ed. Well, joining me now is Melissa Davies, Chief Economist at Redburn Atlantic. Melissa, good to see you this morning. I mean, sterling has fallen to its lowest level against the US dollar since end of May. I mean, clearly the market is having second thoughts on whether the MPC moves tomorrow.
Yeah, it's a super interesting morning, actually. And UK markets have been so sensitive to every data point, really. So, yeah, it's quite extraordinary, actually, that markets are now pricing no change, given inflation still is pretty high, 6.7. Wage inflation is only just below 8%. There's a really, really long way to go in terms of the monetary tightening cycle. Real interest rates are still negative, so we think it's highly unlikely that they won't hike tomorrow. And actually, the Bank of England does need to keep going, actually.
That's very, very interesting. So what is the case for another interest rate hike tomorrow? Is it all down to what's happening with wages just now?
Yeah, exactly. So wages are far too high relative to the bank's inflation target. And although inflation is coming down quite briskly, it's quite easy to get to 4.5% in the next few months. Beyond that, the reductions thereafter are going to be quite tough. And there's survey data that the bank's produced that suggests, companies are going to defend their profit margins next year. So, we're going to go into next year with inflation still, double the bank's target, wage inflation too high, and just a very inflationary backdrop, basically, and with financial conditions that are not particularly tight. And today is a case in point. If you've got weaker sterling, you're not tightening monetary policy enough.
Yeah, Melissa, one thing that jumped out at me in the numbers today was the core inflation number, down from 6.9 to 6.2%. I mean, that is a big, big jump. Does suggest that some of these so-called second round effects are starting to unwind. I mean, that does give the doves on the MPC a bit of ammunition.
I mean, it does. So you had a fall in restaurant and hotels prices, transport. So I'm not convinced transport side of things is going to continue. But again, we're at very high levels. It's really there's still a really, really long way to go in terms of bringing inflation down durably. And what you've seen in the US, for example, is they got down to 3%, and now inflation's going back up. So it's really, really tricky, and it's important not to declare victory too early, because you're only going to create a bigger problem down the line, basically.
Melissa, while we've got you, it's not only a coin toss at the Bank of England tomorrow. The Federal Reserve obviously meet their latest decision this evening. What are you expecting to see there?
Yeah, so it'll be no change from the Fed. That's widely expected, and then it's more about the messaging for the 1st of November meeting. So we think they should hike in November, and the expectations are around 50-50 as to whether they will. So tonight it's really how Powell addresses this issue of inflation picking up again, basically. Gasoline prices have been rising in the US. That's feeding through to headline inflation. And there's a real debate around how much that rise in headline inflation is going to feed back into the core, and how much additional tightening you're going to need as a result. You've also got the car makers strike in the US, so potential for a bit of pressure on car prices. So Powell's really kept his powder dry in terms of making a judgment on what needs to be done about this bounce in inflation, and we're certainly crossing our fingers that it's not going to be a rerun of the transitory argument, because obviously that didn't end well for the central bank. So we hope they're not going to just look through this bounce in inflation and tackle it, but obviously the risk is that they're too dovish and they get behind the curve again.
Didn't end well for the rest of us, not alone the central banks.
No,
Melissa,
no, exactly.
good to see you.
Didn't end well for anybody.
No. Thanks, Melissa. Good to see you again.
Brilliant. You too. Thank you. Cheers.
Now, the Prime Minister looks set to scale back on green pledges, and that could mean a delay of the 2030 ban on new petrol and diesel cars by 5 years to 2035. Car manufacturers are, of course, in the process of huge change to go all electric, and they've been responding to this possible change from the government this morning. Well, Ford put out a hard-hitting statement. It said, "This is the biggest industry transformation in over a century, and the UK 2030 target is a vital catalyst to accelerate Ford into a cleaner future. Our business needs three things from the UK government: ambition, commitment and consistency. A relaxation of 2030 would undermine all three." Stellantis, which owns Vauxhall, said Stellantis is committed to achieving 100% zero-emission new car and van sales in the UK and Europe by 2030. Our range will progressively move towards 100% electric ahead of current legislation. Clarity is required from governments on important legislation, especially environmental issues that impact society as a whole. Well, with me now is Mike Hawes. He's Chief Executive of the Society for Motor Manufacturers and Traders. Mike, welcome to you. We obviously haven't had confirmation from the government yet, but they're not denying any of this. What's your reaction?
Well, it is a degree of concern. The industry, as you've heard, is investing billions into this transformation, and you're seeing it happen in the UK. And you've also seen the government support that with Tata's investment in Somerset, BMW in Cowley. One of the reasons you're able to attract that investment is having a strong market. We need the market to move. We've sort of moved from the early adopter, trying to get into mainstream. So consistency of message is absolutely key here. This is going to lead to a certain degree of uncertainty, but we wait to see ultimately what the Prime Minister says.
So your concern primarily then is that this delay could deter some customers from buying new EVs?
It could cause some delay, however, and this would come at a time. One of the things we still expect, despite what we were hearing overnight, we still expect the introduction of a zero-emission vehicle mandate, which will compel each brand to sell an increasing proportion of their vehicles to be pure electric, starting 1st of January at 22%, rising to 80% by 2030. Now, the industry can and will put those products on the market. Will the demand be there to sustain that transition?
But look, Germany, the biggest car market in Europe, they've watered down their plans to ban the sale of new petrol and diesel vehicles. Why shouldn't the UK?
Because I think if you look, Germany obviously part of you, look at the European level, and the European is a quite a diverse market. You will see the Netherlands, you'll see Denmark and many others probably going ahead of targets. I think Germany will be in the forefront of that transition as well. Maybe Southern European markets, some Eastern Europeans, will be the later in the transition. The UK, we're one of the biggest markets in Europe, relatively affluent. We love technology as a society. We're densely populated, so that lends itself for the infrastructure. We should be leading this. And so as a market, we should be leading. And as a country, I hope we can continue to lead.
Do you think it's going to have any impact on employment in the sector if this ban is pushed back?
I don't so much on employment. I think that clearly we're trying to anticipate and speculate as to what is going to happen. The industry is still committed. It's still making those investments. I don't see that changing. As long as we maintain a strong market and a strong competitive environment, we'll still be able to sustain or perhaps even grow that industry, because that's ultimately what we're trying to do.
What struck me, Mike, was, we read out the reactions there from Ford and Stellantis, and there are others like BMW who own Mini saying very much the same thing. Does that mean that everyone is ahead of schedule right now? Are there none of your members that would appreciate the ban being pushed back a little?
I mean, it's a tremendously diverse industry in the UK, from small manufacturers, luxury, premium, and their model cycles are longer. But, what we anticipated was a degree of flexibility in all of this anyway. Ultimately, they all want to get there. The question is making sure the market moves with you, because, as I said, we can develop the products, but unless the demand is there, and any mixed messages can potentially cause consumers to say, I'll wait a bit. That's not good for the industry, not good for the exchequer, and not good for the environment.
So on that basis, then, if this ban is pushed into the future, could you live with that if the government were to perhaps offer more incentives to motorists to switch from fossil fuels to EVs?
I think, we had a conference this week, and, the Transport Secretary, Mark Apple, was very supportive and, clearly understands the challenge that we face. It is about moving a market, and what we've seen is the private consumer beginning to hold back on EVs, maybe cost of living, but also, especially about the infrastructure. business buyers continue to invest because they've got the fiscal incentive. You need the private sector incentive. Pull every lever to get us there.
Oh, Mike, good to see us ever this morning. Thank you. Some other business news stories for you now. And the bakery group Finsbury Foods has agreed to a £143.4 million takeover by the Isle of Man-based asset management company DBay. Finsbury Foods, which is based in Cardiff, makes own-brand buns, rolls, hot cross buns, donuts, muffins and artisan bread to most of Britain's big supermarkets, including Tesco. But it's also the UK's largest supplier of large and celebration cakes. It also makes Thornton cakes. But the new owners said Finsbury requires a more aggressive acquisition strategy to grow the business, which could not be done while it remained a listed company. The fund manager M&G has returned to the so-called bulk annuity market. That's the business of taking on the responsibility from an employer for paying future pensions to its employees, with the completion of two so-called buy-ins worth £617 million. Well, the news came as M&G reported adjusted operating profits of £390 million for the 6 months to the end of June. That was up 31% on the same period last year and was despite a drop in assets under management from £342 billion to £333 billion. The shares have risen by 4% on the news. Still to come here on Business Live. We'll have a look at how the markets are doing this Wednesday morning. Don't go away.
Breached the road. There is a lot of gas being fired all around us. शांति से इनको समझाओ वरना ये हम लोग It is an absolute carnival kind of atmosphere out here for Prime Minister Modi's decisive victory. These students are defying the prohibitory orders and now they're going to be arrested. We aim to be the best and most trusted place for news. The roads have been inundated. The only way out is to get people by boat. What is feared that over 200 people might have died because of these landslides. This on any given day would have been bustling with people, but today it's absolutely deserted. This is one of the most sensitive areas of northeast Delhi where there's been clashes. I'm Neville Lazarus and I'm Sky's reporter based in Delhi.
Fly Emirates, fly better. Fly Emirates, fly better. Thank you.
Welcome back. Bit of breaking news to bring you. The Prime Minister, Rishi Sunak, is going to deliver a speech in Downing Street amid speculation that he's going to water down his net zero commitment. The bad news for regular viewers of our 4:30 show is that it's at 4:30 this afternoon. I fear you might not be seeing me this afternoon, but we'll hope for the best. Thanks very much, Downing Street. Anyway, let me talk you through some of the other business stories that we have now. Shares of Pearson fell by more than 4% this morning after its chief executive, Andy Bird, unexpectedly stepped down after 3 years in the job. The world's biggest educational publisher said Mr. Bird, a former Disney executive whose career began with Piccadilly Radio in Manchester, had decided to retire. His successor will be Omar Abosh, who's currently president of Microsoft's Industry Solutions business. He'll take over early next year. The homeware retailer Dunelm has reported a drop in annual profits, but predicted an improvement for the new financial year. The Leicester-based company, which trades from 177 stores, saw pre-tax profits for the year to the 1st of July fall by 7.8% to £192.7 million, which it said reflected tough comparisons with the previous year, when there was still pent-up demand following the final COVID-related lockdown. But it said more recently it had been able to pass on cost savings from lower freight rates, and it had cut prices on more than 1,000 lines. And shares of the gene therapy specialist Oxford Biomedica surged by 16% this morning on news it's in talks to buy ABL Europe, a French company that specialises in the development and manufacturing of solutions for biotechs and biopharma, including viruses for gene therapy, viruses and vaccine candidates. Dr Frank Mathias, Oxford Biomedica's chief executive, said the potential acquisition would augment the company's position as a world-leading quality and innovation-led contract development and manufacturing organisation in the cell and gene therapy field, while giving the company a footprint in the EU. Well, the news came as the company reported a widening of half-year losses from £27.6 million to £52.7 million. Well, as I mentioned earlier in the programme, the pound fell against the US dollar to its lowest level since the end of July after the unexpected drop in inflation in August. It's off currently about 1/4% against the US dollar. It's off by nearly 1/2% against the euro. The single currency, meanwhile, up 1/4% against the greenback. On the equity markets, after last night's declines on Wall Street, stocks in the Asia-Pacific region traded largely to the downside. The biggest decline, though, in the region was in India. The main index there fell by more than 1% in its biggest one-day fall for a month. That followed bad news from one of the country's banks. Well, here in Europe, stocks are trading to the upside right now. Here's the picture. All the main indices in positive territory. Talking points today include Commerzbank, Germany's second largest lender, up 1.25% in Frankfurt on the back of a trading update. Here in London, the FTSE 100 also in positive territory. That's largely in a broad-based rally led by the dollar earners. In percentage terms, though, that benign inflation data has lifted the house builders and commercial property stocks. Among the leading FTSE gainers just now, Taylor Wimpey, Barratt Developments and Land Securities. Look at that, all ahead by more than 4%. Segro, another major gainer on the day. Outside the FTSE, it's a similar story, with Persimmon and British Land among leading gainers, while First Group has added another 4% following yesterday's contract extension for its Avanti West Coast arm. Well, as for the oil price, after hitting a 10-month high for 7 consecutive days, it's taken a breather today. Barrel of Brent crude currently changing hands at $93.48 a barrel. That's off 0.9%. With me now is Rachel Winter, partner at Killik & Co. Rachel, great to see you. Let's start with Dunelm. Bit of a mixed bag, but the market quite liked what it heard.
Yeah, I thought overall very good results. This is a furniture company that focuses on the lower priced end of the market, so you would expect it to be doing well in a time of a cost of living crisis. Revenue was very good, a record year for revenues. They've also taken market share. Profits were down a bit, and that was just because costs had gone up a lot. Overall, I thought very good results, but these shares are trading at a very big premium to their peers, and I think that's why the shares haven't gone up a lot today.
Well, the market always loves to see a nice takeover store, and we got one today with Finsbury Foods. I mean, not a widely understood company, really.
No, it's a smaller company on the UK market, worth around £100 million. It's a bakery company, and it makes a lot of bread and cake for the big UK supermarkets. And they this morning have announced a all-cash offer. So it looks as though that company is going to be taking over. For me, this is quite interesting because of what it says about the wider UK market. UK smaller companies have had a terrible couple of years. The consensus is they're very undervalued, and I think we're likely to see a lot more bids coming down the tracks.
Yeah, this is really depressing, isn't it,
It
in
is.
some respects? You know, they think they can't do all they want to as a public company, so they're going private.
Yeah, and if this keeps happening, what's going to be left on the UK stock market? I agree, it's very sad.
Yeah. Now, Galliford Try is another one that's caught your eye today.
Yes, another good update this morning. So Galliford Try, they are a construction business. They often get lumped in with the house building sector, but actually the house building is quite a small part of what they do. Most of what they do is big infrastructure projects for the government. So they're involved in lots of road building, hospital building, building of schools. That part of the business is very long term, and it's actually been very resilient while the house building sector has been falling.
Yeah,
So
they complained bitterly when I referred to them as a house builder the last time I mentioned, so I better not do that again.
Yeah, I think it's only about 13% of the company, so the vast majority is the construction. So they've been very resilient in comparison to the wider house building sector. Nice increase in the dividend today, so very good results this morning.
Yeah. Now, in terms of companies reporting today, probably the biggest of the bunch is M&G. What did you make of that?
Yeah, often quite overlooked. So this company spun out of Prudential a few years ago, and I think it was viewed as the low-growth part of the business, so it's often not really looked at. A lot of the business focuses on a legacy annuities business, which hasn't previously been taking on new clients. So I think that's why people viewed it as low growth. However, in the update today, they have said they are taking on a small number of new clients. So I think this will really get investors interested, and perhaps this might, again, be viewed as a bit of a business with a growth potential.
Yeah, I thought it was fascinating. They've gone back into the bulk purchase annuity market. I mean, this is quite a crowded space, dominated by the likes of Legal & General. What did you make of that?
Well, I think it's a growing market. Previously, we've had a lot of pension schemes that have been in deficit. Now the interest rates have gone up. A lot of those schemes are now in surplus, and the companies running them have now got the option to sell them on to someone else. So we're seeing a lot more of that happening. So I think there is a lot of business to go around.
Now, before I let you go, Rachel, we heard from Melissa Davies there. She thought the Fed should raise again tonight. What do you reckon?
I think they'll probably hold and then raise again later in the year.
Well, we shall see. Rachel, always good to see you. Thank you.
Thank you.
That's it from me for the moment. We do have an afternoon edition at Business Live at 4:30. We do expect to hear from the Prime Minister about his net zero commitments. And there's also a lot to look forward to. The Federal Reserve is obviously the big ticket item in world stock markets tonight, and we will bring you that decision later on this evening on Sky News. That's it from me for now. Coming up next, Prime Minister's questions. See you later. Cheerio. Sorry, I had to really canter through everything.